7 ways the rich make money with debt. United States, both the wealthy and the poor carry significant amount of debt. But the difference is, the rich often use good debt to grow their wealth by purchasing assets that can grow in value and might even have tax benefits, such as property or stocks, while others get bad debt by buying items that don't generate income or lose value over time, like luxury vacations or car loans. While many podcasts, television shows, books, and magazines are dedicated to teaching us to avoid debt, it's crucial to understand that not all debt is harmful. When utilized correctly, debt can actually be a tool for wealth accumulation. Wealthy people often use debt as a tool to amplify their investments, using a technique called leverage. They borrow money at low interest rates and invest it in opportunities that offer higher returns, allowing them to earn profits that exceed the cost of the debt. This strategy lets them invest in more significant assets without tying up their capital. And although debt can increase profits, it also comes with higher risks, as losses can be more consequential. But when done right, leveraging can grow wealth faster. While this strategy might seem exclusive to the rich, you can also correctly use debt to enhance your investments, and that's what I'll be discussing in today's video. Number 1. Real estate. Owning a home often involves using leverage, commonly known as a mortgage. Essentially, this means you've borrowed money, typically from a bank, purchase or refinance your property. Most real estate investors buy homes using mortgages, then sell them once their values rise. If you have a steady income, you can do the same. Instead of paying the total price of a home, you can pay just a part of it. For example, if you buy a $100,000 property, a 10% down payment is only $10,000. The other $90,000 is covered by the mortgage you'd secure. Even if you can afford to buy a property in cash, using a mortgage is more advantageous due to potential tax deductions and better monthly terms than renting. Another strategy is to rent out your property and use that income to cover your mortgage payments. As you accumulate equity in the property, you can borrow against it to invest in additional properties, creating a cycle of increasing cash flow. However, staying within your financial means is essential when using debt to build wealth in real estate. Mortgage lenders often use a debt-to-income ratio to determine your loan eligibility, which can sometimes reach up to 36 to 40%. However, for your own financial health, aim for a ratio closer to 20%. Stay within this limit and only buy what you can afford. If you're buying a property to rent out, ensure you can cover the mortgage payments even if the property stays vacant for a while. Number 2. Leveraged exchange-traded funds. Exchange-traded funds, or ETFs, are investment funds that track specific stock market indexes like the S&P 500 or the Nasdaq 100. While standard ETFs strive to match the gains and losses of their chosen index on a one-to-one basis, leveraged ETFs aim for even higher returns, potentially doubling or tripling daily index performance by using financial tools like derivatives and debt. Leveraged ETFs let you invest in specific indexes, commodities, bonds, or sectors. They promise more significant profit potential, especially during market booms, allowing you to achieve returns that other investors can only dream of. Take the Direction Daily Financial Bull 3 Times Shares ETF, for example. It is an investment fund that focuses on major US financial companies using the Russell 1000 Financial Services Index as its guide. It charges a 0.99% fee and mainly invests in top-tiered companies like Berkshire Hathaway, Visa, and JP Morgan Chase. The unique thing about this ETF is that it aims to give investors 3 times the returns of the stocks it follows. For instance, if you invest $10,000 in this ETF and the stocks it mirrors goes up by 1%, you could see a 3% return. However, if the stocks drop by 2%, the ETF could result in a 6% loss. This makes it potentially profitable, but risky, making it more suitable for short-term investments. Investing in an exchange-traded fund is relatively straightforward, and the process is similar to buying individual stocks. First, you'll need a brokerage account, which many online platforms now offer without trading fees. Before investing, research the chosen ETF's objectives, assets, associated costs, and past performance. To purchase, simply place an order through your brokerage platform. But don't stop there. Regularly monitor your investment and adjust as needed to stay on track with your financial objectives. Also, ensure that you diversify across various ETFs to reduce risk. And most importantly, stay informed about market trends and consult a financial expert if you doubt your investment choices. Number 3, a leveraged buyout. In a leveraged buyout, a buyer acquires a company mainly with borrowed money, using the company's assets as a guarantee. The idea is that after buying the company, its future earnings will be used to repay the borrowed funds. Once the deal is done, the buyer becomes the acquired company's primary owner or decision maker. The two most common types of leveraged buyouts include management buyouts, where the company's top leaders buy all or part of the business. The other is a buy-in management buyout, where outsiders join with the company's senior management for the purchase. After the buyout, the new owner might change the management, keep the current team with the new targets, or combine both. They often have a significant role in the company's board. While some buyers might use their personal assets or income for the purchase, this is less common in big deals due to the large amounts of money required. Funding for these big purchases often comes from various sources like banks, private equity firms, and pension funds. Number 4. Hedge funds. Hedge funds offer investors unique growth opportunities by diversifying across various assets, including equities and foreign currencies. Experts usually manage these funds using multiple strategies to tap into different investment opportunities. Hedge funds are well known for their extensive use of leverage to magnify potential returns. Some even leverage up to 10 times their assets. For instance, billionaire hedge fund managers like John Paulson have successfully used this strategy to turn accredited investors into multi-millionaires. However, there is a downside to this. Hedge funds are often considered a risky investment alternative and usually require a minimum investment or net worth, often targeting the wealthy. Moreover, if the fund manager's predictions or strategies fail, the high degree of leverage can lead to substantial losses, endangering the fund's viability and the investments of its participants. A classic example of this risk is the case of long-term capital management. Despite its financial expertise, long-term capital management used excessive leverage up to 30 times its assets. When its strategies went awry, it faced insolvency and eventually required a bailout to prevent broader financial market disruptions. So before investing in a hedge fund, it is essential to thoroughly review the fund's documents and agreements. These papers will clarify the fund's investment strategies, location, and associated risks. Ensure the risks align with your investment goals, timelines, and risk tolerance. Look into any disclosed conflicts of interest and research the track record of the hedge fund managers. It's also vital to know how the fund values its assets, especially if it holds less liquid securities, as this affects the fees charged by the manager. Lastly, confirm how the fund measures its performance and be sure it's based on actual assets or cash rather than estimated values. And most importantly, clearly understand any restrictions related to withdrawing your investment. Number 5. Margin investing. A margin account is a specialized brokerage account that lets an investor borrow money or shares from a broker using their existing account as security. This borrowed money boosts the investor's purchasing power, allowing them to buy more securities than they could with their own funds. This process is also known as margin trading. Using a margin can amplify your trades, meaning it increases both potential profits and potential losses. Let's say you have $50,000 in a standard brokerage account. With margin, you can double this, borrowing another $50,000 from your broker, giving you $100,000 to invest. Essentially, you're using your $50,000 as a 50% down payment and borrowing the rest. If the stock you buy increases in value, you can sell it, pay the borrowed amount, and keep the profit. However, there's a catch. If the value of your stock drops below a certain threshold, your broker might issue a margin call, asking you to deposit more money. If you can't, they can sell your stock to recover their loan, possibly resulting in a loss for you. Number 6. Debt recycling. Debt recycling is a strategic way to boost your finances by turning non-beneficial debt, which doesn't increase your wealth or give tax benefits, into productive debt that can grow your capital, generate income, and offer tax deductions. Let's say you get a bonus or inheritance. Instead of spending it, you can use this amount to clear some debt. Then you borrow a similar amount for investment purposes, effectively trading unproductive debt for potentially wealth-building debt. While various ways exist to employ a debt recycling strategy, each carries its own risk level. Therefore, it's essential to consult a financial advisor to determine if it aligns with your financial goals. Number 7. Selling short. Short selling flips the typical trading method, where you sell before buying. When you sell short, you're basically selling stocks you don't own. Here's how it works. You borrow and sell shares from your broker to another buyer. You receive money from the sale but owe those stocks back to your broker. When you're ready, you buy back the shares at their current market price and return them to your broker. The goal is to sell when prices are high and buy back when they're low, which earns you a profit. While this strategy allows you to profit from declining prices, it's not without risks. You'll pay interest on the borrowed stocks and may need to cover dividends they earn while holding them. And though modern technology has made the entire trading process automated and computerized, always consult with experts before diving into short selling. Thank you for watching and staying with me till the end. If you have any comments or thoughts you would like to share, please do so in the comment section below.